Yesterday, we threw a whole lot out there with regards to the broader market, where things can go, and why there's almost an impenetrable numerical case with the combinations of a massive wealth transfer to millennials in combination with inflation and massive growth to the money supply that make a continued bull market basically inevitable on a longer term scale. However, on this channel, we don't focus on playing the market. Yes, we will, do what we have to do with regards to big macro cycles and swings and events that can negatively or positively impact the market, of which we did very successfully last year. Almost scary how successfully we did that. And if you've got more questions about what that means, comments below, happy to answer and provide evidence. We want to beat the market here. And one of the ways we're beating the market is energy. Energy stocks are very well priced and are in a multi-year bear market in which investors have hated on them and not accurately so. We're seeing what happens when you go woke, you go broke in some instances, as Europe is. And Europe has done a whole lot of going woke, and they are experiencing the brunt and the front of this energy crisis. These stocks are very well priced, and if you listen to the CEO of Schlumberger, he expects material near and medium term price or cash flow and margin improvements. Yet the stock is on multi-year lows, close to it. Obviously, we're not down in the 20s per share anymore, but we're not, $60, $70, $80 a share like it had been in the past. However, this company's making a ton of money, but it's prepared to go carbon neutral by 2050. And they're, the case that gets you in your stomach, that makes you really start questioning these energy stocks, is the whole notion that they're going to go away. So as we did months ago, as we want to reiterate again today, we are putting that long-term thesis to bed, at least for companies like Schlumberger and Exxon, who we think are disturbingly underpriced. Now, with regards to more near-term performance, today we opened the day with the price per barrel down, and then we went up to about 1.5%. That's quite a strong intraday move. And typically we'll see some strength in the morning and then have it spill over as the day goes on. I think this indicates that there is more room to go. I understand the run has been very long and maybe it consolidates here. There's nothing wrong with a little bit of consolidation. And at some point we will have some consolidation. But I don't think there's anything wrong with having $80 a barrel oil here. We're seeing demand pick up. It's likely in the next year or two, we're going to hit record high oil consumption. We've already hit record high energy consumption this year, despite some level of lockdowns internationally. These companies are making a whole lot of money, and they're priced very cheaply. So it's an interesting paradigm. The price per barrel is at $82, $83 per barrel. From 2010 to 2014, we had remained above $80 a barrel. That's not too long ago. Yes, it's expensive. Yes, it's seen a run, but there's a good chance, I think the probabilities and the logic make a lot of sense for it to remain above these levels. Now, obviously, after 2014, the price per barrel fell. Why did the price per barrel fell? Well, of course, at high prices, you entice producers to want to collect some of those fees. However, that's not really on the table like it has been in the past. Energy companies don't want to invest in new production right now. The Biden administration doesn't like them, at least U.S. energy companies, and they fear the long-term future of the market. In addition, we're seeing no signs out of OPEC that they want to do anything with production. They just had their fastest meeting ever on record. So I don't see any signs for an increase in production. However, I see continued energy consumption and demand, and these companies are making a lot of money where the barrel was, making a lot more where it is, And if it goes higher, they'll make even a lot more. The long-term thesis is off the table. We like these companies over here. I think today's price action indicates further upside. Halliburton earnings, nothing tremendous there. We'll see what Schlumberger has to say this Friday. And then Exxon is the one I'm watching most closely after that. And of course, the commentary in these names is very important. In addition, the rest of our portfolio remains the same. Those of you who were on the Instagram before we got taken down, the end of last year, we named 3 sectors we were going to be watching this year and be very heavily weighted. They were energy, real estate, and materials and mining stocks. Right now, we are very involved in 2 of those sectors. Real estate has been off the table for a couple months, although it was at one point our heaviest sector. Shout out to Barry Sternlick and Starwood. That was a great return right there. We still have Ashford Hospitality Trust. It's our only real estate play at the moment. Anyways, mining and materials is another area we like. We just heard Steel Dynamics. Unfortunately, this is a stock I had, but sold just a couple days ago to make room for a new addition, BHP, which I think Steel Dynamics is great. There are rumors that they're gonna make the steel for the Cybertruck. I think that will lead to other business opportunities, but they say demand is robust and is likely gonna stay robust, and is robust despite lags in the housing market and the automotive sector. So that is demand that is likely not totally destroyed, but somewhat delayed. Some of it may be destroyed, some of it may be delayed. We'll see. That will come later. Hopefully, we'll see. Hopefully for them. Still got a little bit of Cleveland Cliffs. Got BHP, got GOLD. So we like this sector too. And Steel Dynamics sounded very good. So remaining in the mining names, remaining in the energy names. Of course, we like our cheap growth. Been buying back into CRISPR Therapeutics for the first time since January, February when I sold out of it. Have Editas that's starting to make a move. Have filled up that position pretty nicely down here in the 30s. I don't think it should be here. I think it's a $5 billion company valued at $2 and change billion right now. So it's one I like. In addition to CRISPR, I'm starting to nibble on Virgin Galactic down here. I don't care what Morgan Stanley says. They've got an interesting tech product. They're doing some stuff with the Italian military, and though it sounds like the Italian military is just going to do a security check on it, but it seems like they're going to get some good Italian design in that ship. And Richard Branson, he's a smart guy, cares a lot about fun, design, etc. I think that will prove to be interesting. 23andMe, this is a stock I'm still down on despite a massive run recently. However, like the CRISPR stocks, I think it's a fantastic company. I've had it since the IPO. And we'll see what happens, just to name a few of our growth companies. Because we don't like mega cap tech as growth. We like the products. We like to consume their products. But the stocks I'm not interested in, even though they might do well from here. We'll see. That's for today. Until next time, peace out.